Embark on a journey to financial prosperity as we unveil the core asset classes that can lead you to extraordinary riches. By focusing on these fundamental assets, you can build a strong and diversified portfolio, setting yourself up for long-term growth. Whether you're a seasoned investor or a newcomer, our step-by-step explanations will empower you to grasp these asset classes like never before. Discover invaluable tips and strategies to start your investment journey, even with limited funds. Don't miss this transformative opportunity. Subscribe now to unlock the secrets of the rich and pave your path to financial mastery. The initial asset class to consider is equity, also known as stocks or shares. When you invest in equity, you become a co-owner or shareholder of the company issuing the stocks. For instance, if a company has 10,000 shares available and you own 1,000 shares, you hold a 10% ownership stake in the company. As an equity investor, there are two primary ways to earn returns. Firstly, when stock prices rise, your equity stake's market value increases, allowing for profitable selling, a form of capital appreciation. Secondly, equity investors also earn returns through dividends. As partial company owners, they receive a portion of profits, usually paid out quarterly through electronic deposits, replacing the traditional paper checks. There are two main methods to purchase equities. You can either buy them through a fund, which pulls investments from various individuals, or you can opt to purchase individual equities directly. Equities. If the idea of investing in individual equities intrigues you, it's crucial to concentrate on companies you have a good understanding of. Selecting equities demands a certain level of expertise and knowledge, and I go into greater detail on how to evaluate companies and the factors to consider when picking equities in some of our videos. Nonetheless, if you seek a more convenient alternative, investing in funds could be the preferred route. Funds bundle multiple equities into a diversified portfolio, providing you with the opportunity to achieve the average market return and capitalize on the stock market's upward trend, all without delving into the intricacies of analyzing individual companies. It's important to acknowledge that not everyone finds this aspect enjoyable, and that's perfectly acceptable. While I personally find it fascinating, it may not be everyone's cup of tea. Fixed income securities. To start stock investing, open a brokerage account like Fidelity, Vanguard, TD Ameritrade, or Robinhood. Next, let's explore the second asset class, debt or bonds. Bonds make you a lender, with periodic interest payments and return of the principal upon maturity. You can invest in government bonds for infrastructure and education projects or corporate bonds for business growth. Assessing the borrower's creditworthiness is crucial. Using ratings from agencies like Moody's, Standard & Poor's, and Fitch, AAA-rated bonds are the safest, while lower-rated bonds offer higher interest rates with increased risk. Beware of exceptionally high rates, signaling instability. Bonds are generally safer than stocks, but with less growth potential. Allocate most funds to stocks, especially for young investors. Bonds can be bought through the same brokerage account as stocks, with a minimum investment requirement. Alternatively, bond funds like Fidelity Long-Term Treasury Bond Index Fund or FNBGX and iShares Treasury Bond Exchange Traded Fund or IEF offer diversification without minimum constraints. Liquid assets. The third asset class comprises liquid assets and cash equivalents, encompassing any funds held in your checking or savings account or kept in your wallet. Cash equivalents, also known as the money market, consist of securities that earn a modest amount of interest and can be readily converted into cash. Any debt with a loan term of 1 year or less is categorized as a cash equivalent. Examples include certificates of deposit or CDs, 1-month treasury bills, 3-month treasury bills, 6-month treasury bills, repurchase agreements, and commercial paper. You may have come across news articles about companies such as Apple sitting on substantial amounts of cash. These companies don't typically keep that cash in a regular bank account due to the lack of interest earnings. Instead, they often invest in cash equivalents, such as the money market, to preserve their funds while still maintaining liquidity. As an individual investor, holding on to large sums of cash in a bank account that generates little to no interest may not be the most effective use of your funds. Instead, consider investing in cash equivalents like money market funds such as FDLXX and VMFXX, which can provide a better return on your cash. You can invest in certificates of deposits or CDs through your bank or brokerage account. Alternatively, explore savings account with decent interest rates. Some accounts offer up to 2% interest, a reasonable return. However, cash and cash equivalents are not ideal for long-term investing due to inflation eroding purchasing power. It's not recommended to keep all your money in cash. Consider assets like stocks and real estate for greater growth potential. Property. Let's discuss the last asset class on our list, property. Properties come in various types, such as residential, office, commercial, or industrial. Investing in properties offer two main ways to make money: selling the property for profit when prices rise, and generating rental income while owning the property. Like stocks, properties provide a combination of growth and income. Many investors value properties for their tangible nature, making it easier to understand compared to paper assets like stocks and bonds. One advantage of properties is leveraging bank loans for purchases, making it more accessible than stocks. Rental income covers mortgages, reducing personal funds needed. However, properties require substantial capital. Property investment trusts, or REITs, offer a less capital-intensive alternative, representing shares in real estate companies, trading like stocks, and paying dividends. REITs spare investors from property management. Property crowdfunding platforms like Fundrise, Realty Mogul, and CrowdStreet offer participation in private deals with less control and potentially higher fees. Having covered the main asset classes, equities, fixed income securities, liquid assets, and property, let's consider some alternative options. Precious metals like gold, silver, platinum, and palladium, along with collectibles such as fine art, fine wine, and exotic cars, typically retain value against inflation. Hedge funds, commodities, and derivatives are better suited for high net worth investors and not recommended for beginners. Equities, fixed income securities, liquid assets, and property form the core components of a robust financial portfolio. Equities and properties offer primary growth potential, while fixed income securities and liquid assets provide income, stability, and a modest return on savings. And there you have it. Please share any advice, good stories, or inquiries you may have regarding this video in the comments section below. I'm Wisdom Will. Thanks for watching this video, and see you again next time. Have a great day.